Joining us now is Nilesh Shah, who is the managing director at Kotak AMC. Nilesh, uh, you know, your first thoughts on the IT sector, the kind of disruption that AI is causing to the entire sector and the companies in it. Uh, Even though it may be a medium-term disruption, but the market is factoring in as a short-term impact.
So one, as of today, it is too early to say which way IT sector will get impacted by the AI. When we talk to the IT companies, their defenses, so far no customer has cancelled the contract. Number two, they have witnessed such kind of disruption in the past. They moved from Y2K, replacing two zeros with 2000, to application management, infrastructure management, application development. When SaaS came into play, they moved from data server to cloud management, integration of SaaS software. They have witnessed disruption in the past and they will continue to manage this transition. When we hear from AI developers, they are talking about replacing all white collar jobs in next 18 months. When we go back to IT company, they say, look, a software developer programmer spends about 16-20% time in code writing. 80% time is in understanding client requirement, thinking about how to plan the workflow, and so on and so forth. I think at this point of time, we have clarity to one, keep on watching the developments and then take a call rather than prejudge on either side. Number two, there will be winners as well as losers in this game. Winners will be companies which will leverage AI to deliver cheaper, better, faster solution. At this point of time, it looks like small and medium IT companies are better positioned to leverage AI advantages. The large cap companies may not be in as such a strong position, but there could be always exception to the rule. So at this point of time, we are far more bottom specific, keeping our eyes and ears open, but we don't have high conviction to go either ways. Market prices are at historically low valuation. Now, is it showing investor despair or is it showing the reality? We don't have high conviction on the same.
Sure, understand. But Nilesh, for the retail investor who's lost a whole lot of money in IT in the last 2 years, barring, of course, the last 3 months of a spurt, what should they be doing right now? How much more of price damage before we see some, sustained move in the benchmark of frontline IT names?
So, Aisha, we have no idea when frontline IT stocks will move. There are times when you have to accept that you don't know what's happening. And that doesn't mean that we don't do our work. We continue to meet management. As we speak today, there is one large IT company which has organized AI Day, and our analysts are attending the same. But for retail investors, my recommendation is leave the job to the professionals, whether they are fund managers in mutual funds, AIF, PMS. Hopefully, they'll be able to navigate this storm or crisis better.
Nilesh, while this uncertainty continues and we are not able to take a call on it, the biggest issue with some of the IT and the hyperscalers globally is that a lot of companies which used to do buybacks or used to give dividends may stop or reduce that because they will start investing in infra for AI there, and that would mean your returns to shareholders will come down. Is that a valid concern?
So I think the smart investor knows that today's share price is net present value of future cash flows. Of course, cash flows of current year and next year has higher value. But if with this investment there is growth and which is going to increase the future cash flow, the net present value will discount it. I think many a times I believe companies, bother more about their stock prices than the investors. We, in our interaction with companies, have always balanced on capital allocation efficiency. You have to invest in your business, but just don't invest in any business. Allocate your capital efficiently. And we have given examples of a commodity company which allocated capital efficiently and funded expansion through internal accruals. That commodity company has delivered as good a return or better than many FMCG company, many IT company, many banking and financial services company. So as an investor, I think market is smart enough to understand when you are investing for the future and taking a hit on the short-term profitability.
Nilesh, hi, this is Harsha. Uh, Nilesh, you understand how valuations work, and you're obviously a deep value person. Talk to us about how one looks at valuation at this juncture. We've got Q3 FY26 earnings, which we've now closed. How has the earnings print been, in your opinion, and how do valuations look? Maybe looking and staring out over the next 12 months versus where we sit at currently.
So optically, earnings growth is single digit, but there is one-time hit of labor code. In Nifty 100 companies, all the results which were declared a couple of days back, the profit growth came at 0.8%, but you adjust about 12,000 crore of labor code impact, profit growth became almost double digit at 9.8%. Undoubtedly, December quarterly results have been impacted by labor code and rupee depreciation. Chances are that March 26 quarterly result also could be slightly impacted by rupee depreciation. But on-ground activity seems to be gathering pace. Most cement companies have less than 2 days inventory at factory level. Automobile dealers have about 7 days inventory at dealership level. Steel prices, despite hike, is having strong demand. So overall, there is momentum building up in the economy. This is probably a quarter after 6 quarters where turnover growth is in double digit. So overall, December quarterly number adjusted for labor code and rupee depreciation is moving into double digit earnings trajectory. And we think both FY27 as well as FY28 should witness continuity of double digit growth as seen in December 25 quarter. Keeping that earnings growth in mind, our valuation looks reasonable. They are not cheap by any standard, but they aren't expensive as they were in September 24. September 24, we were trading at about 24 times forward earning with the benefit of hindsight as earnings stagnated. But today we are trading roughly about 20 times forward earning, which is neither cheap nor expensive.
Very interesting. Thank you so much for that, Nilesh. Of course, that's golden advice for those looking to buy gold and silver. so thank you, Nilesh, for that, and thanks for this chat.